Good day, ladies and gentlemen. In this video, I'm going to be explaining how the forex market really works. Okay, so I'm going to be revealing, the secret of what really moves the forex market. So you really need to calm down and watch this video. This is not a video for you to skip. Okay, so if you've been skipping other videos, do not skip this video. All right, because it's going to give you an in-depth understanding of how the forex market really works, and I'll be using three set of things to explain. The very first thing is liquidity. Okay, I'll explain liquidity. I'll break it down to the barest minimum. Liquidity is the first thing I'll use to explain. The next thing is buying and selling. Okay, buying and selling. All right, then the last thing I'm gonna use is take profits and stop loss. You see these three things, these are the things that drive the market, but I won't be explaining the conventional way. Okay, I'll give you a deeper understanding of what is really going on, and I'll also expose market manipulation. How does market manipulation work? Why do we have market manipulation in the first place? So without further ado, let's dive right into it. Okay, so some of you just come to the forex market, you place your buy order, you place your sell order, but you don't really know you don't have an understanding of what is really going on behind the scenes. So I want to give you an overview, a deeper understanding. See, let's say there is a gold chain. Okay, that gold chain costs $50,000. Okay, the gold chain costs $50,000, and based on your analysis, you believe that, oh, this gold chain is going to become more expensive. At some point, it will get to $1 million, for example. Okay, so what do you want to do? As a smart business person, you want to buy this gold chain, at least one piece. You want to buy this gold chain because you know that, okay, when it gets to $1 million, you can sell it. Okay, you sell it off and you make $950,000 as your gain, since you are investing $50,000 right now to buy it. Right now, the thing is, let's say this black line right here, I'm trying to double click on this. Let's say this black line right here is a support level. Let me place it here. Let me move this down. Let's say it's a support level, and that support level is where the chain costs $50,000, right? So at this level, the chain costs $50,000. So you want to buy it. Now the problem is you are not the only forex trader. You're not the only one analyzing the chart. Someone else, a lot of other traders are also seeing that, oh, this $50,000 is a very good price to buy the chain. So they also want to buy it at this level. So this horizontal line right here is the level that is good to buy the chain, and the price at that level is $50,000, for example. Now let's take this resistance level up here as the level you would like to sell it, where it's going to become what? $1 million. Okay, so at this level it is 50k, while up there it is 1 million. Now the issue is, when you buy this gold chain at this level, you want to place a stop loss below the level, and that stop loss, what it means is, you are saying that if the price drops from $50,000 after you bought it, if the price drops from $50,000 and goes to $30,000, you would like to sell and swallow the loss of $20,000. Okay, you stomach the loss of $20,000. Okay, instead of losing the whole value of the chain. So if the value drops to $30k, okay, if it drops to $30k, you are willing to quickly sell it and take the loss of $20,000. So you place your stop loss below the level you bought. Now the thing is, this your stop loss is actually a sell order. When you are buying, your stop loss is a sell order. Okay, it is a sell order because you are saying, if the price drops to a certain amount, in this scenario, in this example, $30,000, you want to sell. Okay, now if you're selling, you're actually selling to another buyer. You are selling to someone else. You can't sell if there's no buyer. So there's always a buyer there to buy from you. Okay, so the thing is, a lot of people are buying from here, buying from here, buying from here, but where the manipulation starts is when you now have big players that also want to buy. Okay, a lot of big players like financial institutions, hedge funds, they're not trying to buy one piece, they want to buy 20 pieces. Okay, so they want to buy a whole lot of gold chains. They are like big companies. They are not trying to buy a single gold chain and put on their neck in order to show off. Understand? Then when the price gets high, you sell it off and make profit. No, they are big companies, so they want to buy it in bulk. They are not buying it one the way we retail traders are trying to buy. So they want to buy it in bulk. Now the problem is they find it difficult buying it in bulk here, because we the retail traders have already started buying, so they don't have much to buy from here. So they do something instead. Okay, so they engineer price to go down towards the level where a lot of sellers are going to be ready to sell. All right, nobody is willing to really sell here. A lot of people are seeing this place as a good place to buy. Okay, me as a retail trader, I've already bought here. Okay, $50,000 I've bought. You too as a retail trader, you have also bought here, and we have all pledged that okay, when the price gets to $30,000, we want to sell. Everybody's stop loss won't be the same. Some people will say, oh, when the market gets to $25,000, well, sorry, when the price of a chain gets to $25,000, I want to sell it. Maybe somebody else will put their own stop loss here. Let me double this. Put their own stop loss here. Say, oh, when it gets to $25,000, I can't take more loss. I will sell it at $25,000. Another retail trader will say, oh, when the market gets to $35,000, so this is where my own stop loss will be. When the market gets to $35,000, I'm selling off, and I will stomach the loss of $15,000. So different stop losses, but they are going to be below. So you have a lot of people who have bought here that are absolutely ready to sell at these levels. They are absolutely ready to sell at this level, but they don't want to sell at this particular level because they feel it's a good and nice level to buy from. So the big players simply engineer price, to go lower by entering some sell orders. So they too will start selling. When they start selling, they influence market psychology to think, oh, if people are selling, it's as if this thing is about to, it's about to lose value. So other people start selling, but this is where the main pool of sellers will be. A lot of stop losses, okay? Because some stubborn people will still hold the chain and say, no, it's still going to go up. The price will still go up. The price will still go up. So they wait for it to get to their stop loss, okay? While some will panic and sell, but as they're panicking and selling, they are also reducing the price to go to the pool of liquidity where you have a lot of stop losses. So when it gets to this level where there is a lot of sellers, okay, a lot of sell orders which happen to be people's stop losses, that is where the big players will now buy. That's the reason why you see market moves towards your stop loss and then pushes aggressively, because they buy everything. They buy a whole lot of, they place a whole lot of big orders at this level. All right, so your when you're buying, your stop loss is a sell order. You are willing to sell at a lower price than you bought. Okay, so when price moves up and then it gets to the $1 million, your take profit is also a sell order. So when you buy, your stop loss is a sell order. Also, your take profit is a sell order. But this time around, it's a good sell order because you're selling at a price higher than the price you bought it, which is the ideal case for you to make profit. You buy low and then you sell high. Okay, so when you your stop loss gets hit anytime you buy, you've also sold. Okay, so but you're selling lower than the price you bought, which makes you put you in a loss. Okay, so I've given you the idea of why there's manipulation. Sometimes the manipulation is necessary for the big players to enter their order. Okay, because if they are to enter where we retail traders are entering, their orders will not be filled completely, just partial. It will be partial fill. Okay, so some of their orders will be filled, some will not be filled, some will be filled at a price that is not too okay, because when they enter the order right here, price will definitely push up. So if they want to enter the rest of the orders, they will be entering at prices that is higher than the price they want to enter. Hope you understand. So because once buying starts taking place in the kind of volume these big players trade, the price is going to move upwards. So if it moves upwards and they buy at a higher price, the profits they will make will be less. You understand? because if they put the orders at this, all their orders at this $50,000, all of them will not be filled at $50,000 because it's much. Some is going to be filled at $55,000, which is the higher level, or $60,000, which is the higher level. They are still going to make profit, but it will be less compared to when they find a way to engineer price towards the stop losses, which will be at a lower price, $30,000. Then they buy in bulk. Even if it's not completely filled at that level, it's going to get filled along the way, maybe at $35,000, $40,000, 45. So it favors them that way. Okay, so that's one of the reasons why we have market manipulation. Also, the reverse is the case. When you are selling, what you're doing is more like, so let me explain this selling part with a resistance level. So let's say this is a resistance level right here. So at this resistance level, the price of what's it called, of a gold chain is $1 million. Now, for you to visualize it and understand what is going on anytime you are selling, when you sell, it's more or less like you already have that thing. Let's say you already have a gold chain that is worth $1 million, but based on your analysis, you feel the value of this gold chain is going to plummet, it's going to go down. So you quickly sell it when it's at $1 million in market value. So while you are selling it to the buyer, you'll be smiling, like, oh, it's a nice chain and all of that. Whereas you are tricky, you know that the value is going to go down. That's the reason why you're selling it. But the buyer is feeling like, oh, he just wants to buy and just have this $1 million chain. So when you have succeeded in selling right here, the market starts plummeting, starts going down, the market value of the chain. So let's say you listen to business news or anything like that, and you find out that, a few days after you sold, or a few minutes or a few hours, depending on what your trading system is. I'm just giving you an explanation. Okay, after you sold, the price of that same gold chain you sold dropped to $500,000, whereas you actually sold it for $1 million. So you're gonna be happy, like you're happy that you sold it and you have $1 million for the same chain that is now worth $500,000. Okay, then later you check the news again and you notice that it has reduced to $50,000. Okay, then at some point you listen to the news again and you find out that it is now at $100,000. So when it's at $100,000, you quickly want to buy it again because you feel from this $100,000 it might start going up again. So you quickly buy at $100,000. You buy back the same chain you sold at $1 million. So how much profit have you made that way? You sold it at $1 million, then you went back into the market to buy the same gold chain at $100,000. So you've made a profit of $900,000. So that's what happens when you actually sell. So when you sell, your stop loss is going to be above the level you are selling. So that stop loss is going to be a buy order. So when you're selling, your stop loss will be a what? A buy order. This will be a buy limit order, a buy stop order rather. So this will be a buy order when you're selling. So let's say you sold at $1 million. Then after you sold it, you notice that the price climbed up from $1 million to $1,250,000. So you quickly go and buy it back at that point. So when you're buying it back at $1,250,000, you are making a loss of $250,000 because you sold it for $1 million. So your stop loss is a buy order anytime you're selling. Okay, so when you're also taking your profits when you're selling, your stop loss is also a buy order. So you're going back to buy what you sold at an expensive price for a cheaper amount. So the difference between how much you sold it and how much you're buying it now is what you're making as your profits. Okay, so that's just the whole idea. So the system now is the reason why when you sell, market is manipulated in the opposite direction before it finally moves downwards. Is the same, it's just the reverse of the case I've already explained. Okay, there are other people that also want to sell. This $1 million level is the level they also want to sell from, but a lot of people, are not buying from that level. A lot of people that understand what is going on, they are not buying. They understand analysis. They are not buying from this level. They are selling. But you also want to sell, and to sell, you need someone to come and buy. Okay, so what they do then is they engineer price upwards. As they have engineered price upwards, those that actually what's it called, want to sell will start doing what? They will start looking for, oh, this price has gone upwards. Sorry, those that sold here, they'll start looking at it like this price has gone upward. It's as if price will keep shooting in the opposite direction. So we shouldn't have sold at this level. So let's quickly go and buy back. You understand? So they will come and start buying at $1,250,000 because they feel it will continue going up. So if they buy at $1,250,000, maybe it will shoot up to 2 million. So they quickly go and buy it back since price is going up and not going down. So while they are actually buying at this level, this is where the big players will now sell. So they will sell from here. Okay, so they will sell from here and then make profits. So the retail trader is going to be confused at that level because after he has bought back, price will just start pushing down again. So you need to scramble to see if he's still going to sell, but he would have already made loss for buying back at this level. Okay, so basically that's just the major idea why manipulation occurs. Those that actually engineer this manipulation, not as if they dislike or hate forex traders. In this market, everybody is looking for their own advantage. That's the truth. Everyone is looking for their own advantage. The big players do what they do because it puts them at an advantage in order for them to be more profitable. So you just have to understand what is really going on and apply it to your trading. Okay, so when you see a position like, let's say you're having relative equal high like this, definitely liquidity will be resting here. So there is a possibility that there will be targets. That liquidity is going to be targeted before price push in the downward direction. Okay, so what do? All you just need to do is, when you see relative equal highs, relative equal lows, you simply try to do what we call confirmation entry. Don't just enter when price gets to this level. Try to wait and get some kind of confirmation that there's a change of character and price is ready to shoot in the other direction before you now try to enter your trade. Okay, so I hope you learned a thing or two from this particular video. If you're a new viewer, please subscribe to the channel and turn on the notification bell. I'll see you in the next video. Thanks for watching.